Well, let's get across one of the big news stories out overnight, of course, the US Labor Day holiday. So really getting a lot of focus what's going on in Europe. That Gazprom, Nord Stream 1 gas pipeline, it's now official. It's been weaponized as a war item because it's now gone and shut down entirely, and it's based off the restrictions that are being put in place, the sanctions on Russia. And until that's removed, that will be kept in place. At the moment, you can see there, that's just one of the numerous headlines that came out from the Kiev Independent on this time, saying that, yeah, it is basically weaponized the gas supply into continental Europe. Not a great sign, of course, for economic activity and social harmony as well, given the importance of keeping people warm over those very cool months. Well, pretty tricky macro environment out there at the moment. Let's bring in Michael Houghton from Lucerne Investment Partners, who joins us as the guest on today's show. Michael, great to go and see you there. Thanks for joining us yet again. When it comes to the inflationary environment, just talking about those gas prices in Europe, we've seen the energy crisis around the world really coming back to the fore again this week. Inflationary pressures, where do we stand when it comes to the outlook there?
Yeah, well, it's interesting, and some of those news items from overnight in particular that you mentioned, David, are concerning because the UK last inflation number was heading closer to 20%, and these energy problems are only going to exacerbate that for them. In the US, it's the same thing, energy prices as well as the cost of living, which you just mentioned, and the fact that inflation is continuing to rise. And at the Jackson Hole meeting last week, the Fed Reserve Chairman made some very clear comments that he will do whatever it takes to manage inflation. So you'll expect to see inflation managed through interest rate rises through the US. And it's the same in Australia. We've still got inflation that's higher than what the Reserve Bank would like it to be. We'd expect to see them raise rates by another 50 points today. It'll probably take up to 12 months for the impact of some of these rate rises to be fully felt. And until that pullback or the reversal in inflation is seen, you're probably going to see central banks continue to make those rate increases.
Michael, we saw that big rebound in the equity markets across, June and July, come to a bit of a shuttering halt, particularly since that Jackson Hole symposium. When it comes to the outlook for equities, so many people go and look to it as an asset class, to a place to go and invest. How do you go and see it at this point in time? Are we getting too optimistic about the earnings outlook, considering we're talking about recession, cost of living pressures, left, right, and centre?
Yeah, definitely. The earnings outlook is something that probably we see as being too optimistic. You've probably heard the saying that in the midst of a market that has fallen, that there's typically a dead cat bounce where the markets might rise quickly and for a short period of time before then things settle back in, and what you expect to see unfold will be, we've still got earnings results to come through, and what those earnings results you'd be looking for is not necessarily what they did previously, but what the guidance is going to be going forward, and what inflation impact is being felt by both consumers and businesses as you look forward. So we would see that value is probably where the opportunity is going to lie in equity markets, not growth stocks. We also think that there's a lot more pain to be felt throughout the economy, both by consumers and businesses, and that's globally. That's not just limited to Australia, but as an indication, the Australian markets for the first 6 weeks of the financial year were up about 8%, and then in the last 2 weeks of August lost 5%. So that's going to continue. We think that volatility will exist, and the traditional way of getting exposure to investments through equities or bonds is probably something that you've just got to be very mindful about how you go about it and what sort of asset classes you participate in.
In that growth space, and of course, a lot of the big tech titans in the US get a lot of the attention. It is really the growth engine when it comes to corporate earnings around the world. Does that make it more vulnerable to the current situation we find ourselves facing?
In the sense that you're relying too much on too little, I suppose. There is going to be big drivers of growth and opportunity, but I think in the next phase, there's this phrase that's going around with a lot of capital investors, and that's dry powder. And a lot of funds, a lot of big funds in particular, and some of the big funds that people probably don't appreciate the size of capital that they have to deploy, like a Blackstone or a BlackRock or KKR. They're sitting around waiting for opportunities, and those opportunities are going, it seems from what we're starting to see come through, is in what's called alternatives. And alternatives is a very broad market, and these investors are looking at property. They're looking at how to participate in that, and they're using debt rather than equity. A lot of PE companies and opportunities for investors in that private equity space is becoming quite limited because you're not actually seeing private equity list as quickly as it used to. They're actually being held in private hands for much longer, and in some cases not listing at all. So getting the opportunity to participate in real growth stories and where the economy could go moving forward is probably going to be more in that private equity space, and being able to access that is obviously not via the listed markets.
Within the PE space, mate, what kind of areas do you want to focus on? Do you want to have hard assets at this point in time, given we're still talking about an environment which is quite inflationary?
Yeah, well, hard assets are an inflationary tool, a way of managing your exposure to any price rises, etc. And so, yeah, you would see that as some of those funds that I just mentioned, and some of the things that we do here at Lucerne is all focused towards real assets or hard assets, and being able to manage those, hold them, and appropriately gear them. But you're leveraging your returns that way. But you're also able to get exposure to something that traditionally has been a fairly good inflation hedge as well.
You mentioned, of course, debt markets as well. A lot of people look at the sovereign curves at the moment. In the credit space, including in that private space, what are the kind of assets that you want to have underpinning these debt instruments? What are the things that you look for, characteristics that don't make you want to go and put your capital with them?
I think at the moment, if you're going to participate in the private credit market or private debt market, you're going to want to have loans that are secured. And typically, as we've just been discussing with hard or real assets, is the safest way to do that because there's something real, tangible underpinning it. The other way you can participate in private credit or private debt is by having security over the assets of a company. And what the other benefit of having that is, and typically we're seeing more and more debt being issued as convertible notes. So if the story does play out really well and you're in a company with the debt, you've got the opportunity to participate in the upside with the conversion of that to equity. But again, we're not looking or wanting to participate in anything that doesn't have tangible assets behind it and real security that allows you to to manage your risk really well, get returns that are recognising the risk that you're taking, and you're not left subject to dilution or collapse just because all you're holding is equity.
Michael, what about the commodity space, particularly the energy space in particular? But given there's not much more investment going into particularly the fossil fuel areas of the other market, how do you see that as an investment opportunity right now? Because that seems to be a real focal point when it comes to what's happening with inflation.
Yeah, and I think one of the key things with energy or resources, and we're probably more focused on resources than energy per se, because as you observed, energy is a finite resource in some respects. If you're using fossil fuels, it's expensive to continue to participate in that market. What we're looking at is renewable energy sources, and that's anything, and we've discussed this before, David, from hydrogen to battery, and how you actually get to participate in that is typically through what the inputs to that is, and that's where the resources opportunity comes into play. There's going to be a huge demand for battery materials over the coming decade. The expectation that renewable energy is going to be the replacement source of energy for lots of economies. You've probably spoken already about the fact that California last week announced that it wants all vehicles to be electric by 2035, and that's one of the world's biggest economies on its own. So if you're looking at having electric vehicles or alternative to gas-fueled vehicles, you're going to have to source those materials to manufacture the source of energy for them, and that's where we're seeing those new battery minerals come into play. And that's also going to be increasingly in demand because there's a finite amount of those available, and until new mines are approved and up and running in production, it's going to be very difficult to be able to supply the materials that are needed to manufacture those. And I believe, for example, Tesla motor vehicles are now on a 12-month wait list because they just don't have the capacity to make the batteries, not so much the vehicles, but the batteries, to be able to continue to supply those.
Yeah, it's a really interesting space as well. Of course, California, you mentioned how big it is as an economy in its own right. I'm telling a lot of residents in LA to go and prepare for blackouts given what's going on with the grid conditions at the moment and power demand. So you can see where that thematic is going at the moment. So keep a close eye on that one. Michael, to finish off, I want to go and ask about sort of the broader debate we're seeing at the moment between private and public valuations. And as someone who invests across both, how do you see this at this point in time?
Yeah, it's actually a really interesting thing to think about. And I suppose the first thing I'd point out is how you go about valuing your private assets is going to be really important as to how your, as a fund manager in particular, performance is going to be measured. And there has been two very clear distinctions set in the last week. And when all the industry super funds reported their June 30 results for the 12 months very quickly, they were using 3 to 6 month old valuations for a lot of their private assets. And that probably didn't reflect a lot of what's flowed through the market up to the end of the financial year. And then when the chair of the Future Fund came out with their results last week, he was quite scathing about not using current return measures and valuations, and that impacted on the Future Fund's performance. But obviously they've used those valuations at June 30. That makes it easier for investors to understand what they're seeing and buying into. And obviously we can't invest in the Future Fund, but just for those funds that do use current valuations, that's a really important distinction. And that's one of the things that we look for when we're looking in the private asset space is, how recent are the valuations? What's the basis of the valuation? Has there been any liquidity event recently that allows you to have some look through? And also, other things that you might want to see are, what contracts they've got, what revenue they're potentially earning, and what their outlooks are going to be. And we're quite happy to sit in the private space. We don't need a liquidity event to be a listing. A liquidity event can take other forms. And we actually are seeing some really good value, and it's been a really good addition to a lot of investors' portfolios over the last couple of years, and has been something that's offset some of the fall that we've seen in those listed markets.